Hi guys, welcome back to another episode. Brian Tracy said at the Wealth Creation Conference at the University of Chicago that wealthy people all share similar behavioral habits. Notice the word habits. They're super organized and disciplined, and that kind of behavioral discipline is the start of any success. It all comes from a continuous chain of consistent actions aimed at a goal. Welcome to the most dangerous, fierce, and toughest job in the world. But hold on, you might not even think that way right now. You're probably thinking, aren't I supposed to buy something and sell it for more, or vice versa, using just a laptop and a button? And that's exactly where things get risky. This topic is backed by statistics, too. A credible financial institution in the US, Prudential Financial, studied 10,000 traders over a decade and stumbled upon some shocking and eye-opening results. After 5 years, only 7% of those traders who came in with high hopes and dreams of getting rich overnight were still in the game. That means a staggering 93% waved goodbye to trading in just a few years. Even more surprising, only about 5% managed to achieve consistent profits and actually make money from this market after that 5-year mark. It's a tough world out there for traders. So, about 95% of people in this market end up failing. What's even more intriguing is that most of these folks are pretty smart and hardworking. Yeah, it's true, this job is totally different from others. Although his appearance shows something else, I really believe that the world of trading is a massive trap designed to pull you in. But hey, don't sweat it. The good news is, we're here together to learn and navigate this landscape. Let's tackle it as a team. So, remember when I mentioned that only 5% of traders are successful and can consistently make profits? Well, those successful ones definitely have a specific behavioral pattern and method that works for them. The key is patience, and we're here to teach you all the ins and outs of those techniques. But you've got to promise to watch these videos multiple times, take notes, and really practice what you learn until it becomes nature for you. It's all about turning those habits into your daily routine. Charles Duhigg in his book The Power of Habit says, "Tell me your habits, and I'll tell you your future." Think about it, those little things we do every day, whether it's grabbing that morning coffee, hitting the gym, or binge-watching Netflix instead of studying, all add up in the long run. So, if we want a brighter future, we really need to take a good look at our habits. It's pretty wild how a few simple changes can shift the whole trajectory of our lives, don't you think? Many traders believe that mastering technical analysis is the key to success. So, whenever they face losses, they quickly think, I need to learn more and start over. For instance, someone might have been trading using Ichimoku, but suddenly they feel that they should dive into Elliott waves. They learn those, and after the next loss, they believe it's time to pick up on harmonics patterns or maybe even price action techniques from the Ulbrooks method. It's like a never-ending cycle of chasing the next big strategy, thinking that one more course will finally unlock the secret to winning trades. There are these 95%ers out there learning every single day, and it's interesting because they're losing money while they do it. Meanwhile, a lucky 5% are raking in the profits daily. The real problem? So many traders don't realize that to succeed in the trading world, you absolutely need a trading system. Seriously, I can't stress this enough. A solid trading system is crucial for hitting those goals. When it comes to trading, it's all about having a solid system in place, and it definitely needs 3 key components. First off, there's strategy, which blends technical analysis with those crucial buy and sell signals you're always on the lookout for. Then you've got money management, which is all about figuring out how much you can stake on each trade. Essentially, it's the trade volume that keeps your portfolio balanced. Last but not least is psychology. This is where managing emotions like fear and greed comes into play, because let's be real, those feelings can throw your whole game off track. Having a comprehensive approach that covers these aspects can really set you up for success. Jeffrey Kennedy, the author of Elliott Wave Trading, puts it pretty interestingly. He claims that a successful trade, or really, a successful trading system, is 60% psychology, 30% money management, and only 10% trading strategy. Isn't that fascinating? What's even more intriguing is that all those unsuccessful traders pour 100% of their effort and energy into that tiny 10%. No wonder they end up taking a hit. It just goes to show how important the right mindset and risk management really are in trading. I hope you're not feeling tired yet because things are just getting interesting. So, let's kick things off by diving into how to build a solid strategy, and then we'll work our way to the most crucial part, psychology. Stick around. It's going to be enlightening. The term strategy originates from the Greek word strategos, referring to military commanders who led small groups of soldiers in ancient Greece. These commanders were responsible for formulating plans and tactics to effectively confront and counter the schemes of adversaries. Thus, strategy inherently involves having a predetermined plan aimed at neutralizing threats and achieving specific objectives. This historical context highlights the importance of strategic thinking not only in military applications but also in various fields such as business, politics, and personal development, where careful planning and foresight are essential for success. Trading is a lot like being on a battlefield, right? You're the commander, and your trades are like soldiers following your orders to secure that victory. The market and its moves are the enemy, constantly shifting and trying to throw you off your game. And at the end of a trading session, your account balance is basically the scorecard that tells you how well you fought. Just like in war, strategy and quick thinking are crucial if you want to come out on top. If you've noticed, I've used the term trading period. The win or loss of a trade is really just like surviving or losing a soldier on the battlefield. I mean, which war doesn't have its casualties, right? For a commander, the outcome of the battle is what matters most, but ideally with minimal losses. No commander goes into a fight thinking it'll be completely without casualties. It's all part of the game, both in trading and in war. So, if you've decided to dive into the world of trading and entered the battlefield, you gotta understand that some of your trades, or soldiers, are definitely going to get lost along the way. Trading isn't like a math class where 2 plus 2 always equals 4, it's more like navigating through a foggy maze. Even with all the technical or fundamental analysis you do, there are just too many unpredictables out there. You've got to be ready for the rough patches because, trust me, losing some trades is just part of the game. The market can flip-flop at any moment, and it doesn't always play by the rules of our analysis. So, you might wonder, why bother with a strategic approach to trading? Well, the answer is pretty clear. Having clear-cut rules in a trading strategy helps us choose entry points in the market based on a consistent, predetermined method, which can boost our chances of winning. It's like having a game plan in a sports match. Without it, you're just reacting to the game instead of playing to your strength. When we develop a trading strategy, we establish clear parameters for our stop-loss levels and determine when to exit a trade. A well-defined trading strategy prevents our emotions from taking control over our decisions, ensuring that we make rational choices based on established criteria. This disciplined approach is crucial for maintaining a consistent trading performance and increasing the likelihood of profitability over time. By adhering to a strategic plan, traders can better manage risks, respond effectively to market fluctuations, and ultimately enhance their chances of achieving favorable outcomes in their trading endeavors. George Soros, a prominent trader in financial markets, achieved remarkable success on September 16, 1992, by shorting the British pound, resulting in over $1 billion in net profit. This bold move not only solidified his reputation but also made him a key figure in finance. In an interview with the Wall Street Journal, Soros attributed his success to a straightforward approach. Before entering any trade, he meticulously answers 3 clear and precise questions. This disciplined methodology emphasizes the importance of careful analysis and strategic planning in high-stakes trading scenarios. Soros' experience serves as a valuable lesson for investors regarding the significance of thorough preparation and critical thinking. George Soros says he always asks himself 3 important questions before making a trade. First, he figures out where and based on what criteria he should enter the trade. Next, he decides where he'll take his profits if the trade goes well. Finally, he determines the point at which he'll exit to cut his losses if things don't go as planned. This clearly shows that Soros is a super strategic trader, and it's pretty obvious why he's so successful. Just remember, Ichimoku, Elliott, price action, harmonic pattern, smart money, trend line, support and resistance, and all that stuff aren't really trading strategies on their own, they're more like tools in your toolbox. Technical analysis is the foundation for building a solid trading strategy. The real magic happens when you can clearly outline your entry conditions, take profit levels, and stop-loss points on paper. If you handed that paper to 10 different people and they all agreed on exactly when to enter the market and what their targets are, then congratulations, you've got yourself a trading strategy. Imagine you've jumped into a trade at this point in the market for whatever reason, and you've set your stop-loss here while considering these points as your price targets. When I say everything should be written down and clearly defined, I mean you should jot it down for yourself. 1. Close 50% of the trade at the first target and move the stop-loss to the entry point. 2. Close 30% of the trade at the second target and adjust the stop-loss to the first target. 3. Close the remaining 20% at the third target. This way, you've got a solid plan and can manage your trade confidently. You really need to take a deep dive into your trading strategy and put it under the microscope to figure out whether it's actually making you money or not. It's all about crunching those numbers and understanding how your approach stacks up. Only then will you start to feel confident about your strategy and your trading skills. When you can see the results in black and white, you'll feel that good vibe about what you're doing, making it all the more exciting to keep pushing forward and improving. In this market, there's no strategy that completely eliminates losses. If someone claims that, you know they're just trying to scam you. Remember, every strategy has both gains and losses, but what really matters is the overall outcome of your trades. Keep your head in the game. So, I hope by now you've grasped just how crucial it is to build a solid strategy and its impact on profitability. But here's the kicker, much of that strategy goes hand in hand with capital management. When you're trying to create a trading strategy, there are two big questions you need to answer. The first is figuring out which market matches your investment amount. The liquidity in financial markets is a key factor that helps you choose the right trading market for yourself. Your investment in any market should match its liquidity and volume. For example, if you're working with a small amount of capital, trading in low-volume cryptocurrencies isn't a smart move because you probably won't see any real profit. It's all about finding the right fit for your fund. So, what kind of time frame are you thinking of using? Smaller ones like 1-minute or 5-minute charts can be super fast-paced and way more stressful. You've got to keep your eyes glued to the screen, and the market you pick needs to have high liquidity. Plus, you'll need to be really good at technical analysis to keep up. One of the great things about trading on a lower time frame is that it only takes a couple of hours out of your day. After that, you can just move on and live your life without your mind constantly stuck on trades. It's like a little pocket of time where you get to focus on making some quick gains and then enjoy the rest of your day free from the stress of ongoing trades. So, when you start using bigger time frames like the 4-hour or daily charts, everything flips around compared to before. Choosing a time frame is completely a personal matter and depends on many things. For example, if you're someone who gets impatient easily, going for a weekly time frame might feel like torture. So, be real with yourself and figure out what works for you. Find a time frame that vibes with you, no need to make it harder than it has to be. So, once you've figured out the right time frame and market for your trades, it's super important to have clear rules for when to jump in. You'll need to set your entry triggers, stop loss, and take profit levels. Having these guidelines not only keeps your trading organized but also helps you manage risk better. When jumping into a trade, it's super important to make sure you're not jumping in too early, whether it's time or price related. That's why having an entry trigger set up before diving into a trade is crucial. An entry trigger means you wait for the price to hit your priced zone and then you establish criteria to confirm your strategy. Finally, you set a condition that acts as the actual entry trigger. It's all about being patient. The best approach is to trade like crocodiles. Crocs are the most skillful hunters on Earth. They can sit perfectly still for hours, or even days, waiting for their prey. That's why they've survived for over 2 million years. You can totally create your own trading strategy using the technical analysis skills you have. First things first, just chill and wait for the price to hit your ideal zone. Once it's in that sweet spot, set some conditions for jumping into the trade. This could be anything from specific patterns to confirmation from indicators. Finally, decide on how you want to actually make your move, whether it's through a market order when conditions are met or something more strategic, like a limit order. You just gotta know that no matter what method you use to get into a trade, you need to have complete control over it and feel totally comfortable with it. It's all about confidence and really understanding your approach. The stop-loss point is basically where your reason for entering a trade goes out the window. It really depends on your strategy, like it could be behind a candle, below a pivot point, or under an order block. If you can't protect your profits, you've got nothing to shield your losses. Little by little, your investment slips away, and before you know it, you're saying goodbye to the market. Keep an eye on your gains to avoid that situation. Most traders usually have a solid plan for their stop-loss, but when it comes to preserving profits, they often have not any plan. It's funny how people can get so focused on cutting their losses that they forget to have a strategy for actually locking in gains. A bit of planning for profit-taking can really make a difference in the long run. Once you've jotted down your trading rules, a new challenge pops up. How do you know these rules will actually be profitable? To figure this out, you've got to take your rules back in time and do some backtesting. It's like putting your strategy under a microscope, analyze past market data to see how it would have performed. Record your wins and losses, and after crunching those numbers, you'll get a clearer picture of whether you're likely to come out ahead or if it's time to tweak your approach. Imagine a medical student who's just finished their studies and is immediately thrown into a heart surgery. They're told, all right, with your knowledge so far, go ahead and widen the patient's coronary arteries a bit. Yeah, right, clearly that patient isn't coming out alive. That's basically what a test in trading is like. It serves the same purpose as that hands-on experience for a med student. Just like surgeons need to practice before they operate on real patients, traders require that test run to develop the skills and instincts needed to navigate the real market. My friend, trading is definitely a skill, and just like any other field, it requires time and effort to master. It's not just me saying this, the stats back it up too. So, take your time and approach the growth and development stages of trading with patience and focus. Rushing through the process won't get you far, so embrace each step. When you're backtesting your trading strategy, it's essential to answer a few key questions to really understand how it performs. First off, what's the maximum number of consecutive losses you've hit? That can give you a good sense of how much pain you might have to endure on your journey. Next, think about your biggest win. What's the highest profit you've scored? That'll help you gauge your potential upside. Lastly, you want to know your risk-to-reward ratios. What's been your best and worst? By digging into these stats, you can get a clearer picture of the strengths and weaknesses of your strategy, which is super important for making informed trading decisions down the line. All this info is crucial for writing effective capital management rules. Plus, running backtests can really help with managing emotions, which is a big part of being a trader. When you trust your strategy and see it's profitable, it boosts your self-confidence and makes you feel more secure in your trading decisions. It's all about building that trust in yourself and your method. After backtesting, it's time for forward testing, where you need to evaluate your trading strategy in real market conditions. You can use paper trading, which basically means trading on paper, or you can try out demo accounts. However, I think it's way more beneficial to do this on a cent account or with a small amount in a real account. The reason is that you won't really get to experience market psychology, like fear and greed, unless you're in a real trading situation. Okay, hope you find this video helpful. In the next one, we'll be diving into money management. Until then, take care and